Pradeep Pishai is Chairman with Asia Fund Advisors. He joins us live now. Pradeep, morning. Thank you for joining us. Are you a bit rattled and nervous with what's happening to the rupee?
Yes, of course. No one likes the rupee to slide so much and so fast. It adds to inflation, it adds to our current account deficit, and of course we are on a fragile wicket as far as our foreign currency reserves go and our investment grade rating goes, and so all that becomes a worrisome issue when you have such a big slide in the currency.
Pradeep, do you think the rupee now breach of 61 to the dollar and they're not seeming any downside or rather bottom in sight, this could have solid repercussion when it comes to the FII money actually pulling out of equities?
Yes, but you see, all is not irretrievably lost. We have seen the central government recognize the fragility of our investment grade rating and start action 6 months ago. And now you've seen some accelerated action, for instance, the gas price announcement, which will allow for an increase in exploration expenditure. You also see, for instance, the coal pass-through for power companies. And there's a lot of talk on defense. Now, I get a little worried when they take so much time, for instance, to even increase from 26 to 49% in defense. They should allow such limits as would enable defense business to be brought into India rather than exporting jobs overseas. We have 86,000 crores of capex on defense in this budget alone, and then every year at least 750,000 crores over the next 10 years will be the import bill on defense items. So if we can get that production into India, we'll create jobs here. So there has to be some aggressive policy change at the center. It has already started, but a great opportunity is with the Reserve Bank of India. I think the Reserve Bank must now recognize that its movements were very good in keeping inflation under control. The headline inflation rates have come down, but any further reduction is unlikely to be possible with interest rates alone. For instance, your diesel subsidy, that has to go up, the diesel price has to go up, and that will result in the suppressed inflation becoming manifest, because diesel feeds in through cost inputs into almost every commodity. Not only that, the global cues for inflation are very benign just now. All commodities, whether it's iron ore or coal or even gold, all have fallen in value, which will translate into reduction in cost of these commodities. Further, we have seen that currency depreciation feeds into inflation. So to change the sentiment of FIIs and to promise them that we will recover back to the growth path, we need to bring down interest rates. Reduction of interest rates can bring about an improvement in aggregate demand, not only for high value consumer durables such as automobiles and housing, but also for investment grade items. As also, for instance, today we see a sluggishness in consumables. There is a discount on biscuits, there's a discount on milk products, there's a discount going on various other consumer products such as soaps and so on, detergents. And so it is a pointer that the economy is very slow. If we change that sentiment by an aggressive stance of interest rate reduction, we will attract FII flows back, and that can again prop up the rupee. Don't forget, the rupee was propped up all this time not by current account surpluses, but by FII inflows and a little bit of debt inflows. There is this fear that if we bring down interest rates, debt inflows will dry up. Yes, there might be a reduction in debt inflows, but finally we will see a higher inflow of FII money going into equities, which is what we want. So we will tide over that problem. As it is, we have seen, because of import duties, a little bit of improvement in the gold imports from 8.9 billion in May, we've come down to 2 billion in June. So that will help, and then if we have additional money coming in from FII, we can see a reversal of this currency decline.
Pradeep, so at a time when consumers are slowing down, there is a discount in car sales, there's a fire sale in biscuits, just about every major consumable merchandise is not picking up. Why are markets still hiding into consumer names?
Well, they are relatively more defensive. Don't forget, commodity prices are have come down very fast, and you see the prices of your steel companies and cement companies and so on, all reflecting this slowdown in investment demand as well as commodity prices. But consumer prices don't come down that fast. There are a large number of consumers out there, and this monsoon will help cushion any deflation in consumer prices, and therefore consumer stocks are definitely defensive. And likewise, if you see pharma, which is closest to consumer stocks in that sense, also is defensive. The domestic pharma industry, which has of course a large domestic market as well as an export market, and they benefit from currency depreciation. So you see some of the pharma stocks being defensive.
Pradeep, what's the call on banks? Because they've been really beaten down, and given the way the currency has been sliding, it doesn't seem like the RBI is going to cut rates anytime soon.
Well, I think give some credit to RBI. They are assessing the situation, and I hope they will come with an aggressive rate cut this month, because I think otherwise certainly we will cause permanent damage, structural damage. For instance, the power sector. By 2015, all the big projects that are to come on stream will have come on stream, but no new projects will come on stream after that, because we have not been making the investment. So if you reduce interest rates, you will see some investment of that sort take place, and without power we cannot really progress. So I think the RBI will recognize some of these difficulties and come with a balanced decision sometime this month. That's what I feel.
Pradeep, but do you think we should stop making song and dance about monetary policy, because Reserve Bank of India in this calendar year, they've already cut rates by about 75 bips. 75 bips is a big number. But very little transmission has happened, and despite a rate cut, demand has not made a comeback. So what will change if they cut rates by another 25 bips?
No, I think 25 bips is way too low. We have to go to 100 basis points at this time. You can't fool around with pennies as it were today. And 75 basis points was done at a time when they were still not in, it was too little, and certainly after that we saw the government tighten up on fiscal expenditure in order to control the fiscal deficit for the March year end. Now government spending has come back, and now if you reduce interest rates or aggressively at least send the signal out, it will take some time for interest rates to be transmitted into the real world, but it will happen, and you will see demand go up, because there is price elasticity of demand for money, there's price elasticity of demand for goods that are bought with money.
Pradeep, what's your view on the food security bill of late, and how it's likely to impact the current account deficit?
Well, at the margin, it can impact the current account deficit, and perhaps without even impacting the current account deficit, if we are able to meet from domestic sources, certainly food prices in the country will rise for those who do not get the benefit of that public distribution system. I think this food bill in some ways, from the heart we cannot criticize it, but from the head we must say that it must be better targeted. It must go to the right people. Now they're talking of Other is not yet reached all people. It's reached 400 million people, and it'll never reach the really poor who do not have a ration card or some paper identifying that they exist in real life. And so they will be left out of the system. That is not what we want. In fact, better targeting of the public distribution system that exists today by improving its structure, improving its implementation, can achieve a lot. So I'm not totally against the food subsidy through this real assets being given out, real food products being given out. It certainly can help the poor, but it must be better targeted, must be better implemented.
So Pradeep, do you think we should now write off the second half of this financial year for Indian equities, because the next 2 quarters earnings are unlikely to improve? Whatever policy action Government of India will announce, benefits will only kick in after 6 months, and in all probability, given the way how Rupee has moved and how other macro variable factors have moved, maybe consumer demand will also not make a comeback.
No, I think that is a pessimistic scenario that is sort of assumes that there will be no action on, for instance, interest rate cuts, that there will be complete policy paralysis in Delhi. At some stage, Indian equities look attractive at a currency and price earning combination. They will be attractive for foreign investors to come in. At this time, certainly Indian politics looks rather dismal, that decision making has slowed down, that there are scam after scam, and whatever is sought to be done is undone by these kinds of perceptions of scam. And then therefore, and of course we've seen US interest rates rise, and that is taking money out of the US bond market and back into equities in the United States, and perhaps in short-term instruments still it is parked in equities. So certainly there is a reorientation of funds flows going on, Japan is booming with a currency drop. They are back in the reckoning. And so money will flow into Japan. Now, to carve a portion of that, those large money flows that are sloshing around in the world, we must improve the outlook for growth for our country. And here we have simple tools such as interest rates, such as, we are worried that people will invest in gold if we keep interest rates down, but that's not so. First, we have seen gold prices come down dramatically, and so people realize that gold can fall in price. Second, improve our KYC norms and so on. We have so much paperwork for poor people to fill up to be able to invest in financial instruments. Can you not improve that and make a unified form so that and a simple form, so that anyone can fill it up and be a participant in the financial instruments market? And just saying that we are bringing out these inflation indexed bonds doesn't make sense. That is a complex product. It is not proven to investors that it will make money for them, it will give them sufficient rewards. So people will go for tried and proven instruments in the first place. So let's attract them in fixed deposit banks and mutual funds and so on, and simplify the paperwork so that they can participate in it instead of going into bonds, into gold, sorry.
Pradeep, good chatting with you. Appreciate you taking the time out and joining us this morning.